The global coffee economy did not begin in boardrooms, stock exchanges, or multinational corporations. It began quietly in the highlands of Ethiopia, where coffee grew wild and consumption was deeply cultural rather than commercial. For centuries, coffee existed outside global trade, embedded in local rituals and social structures. Its transformation into a global commodity would reshape economies, labor systems, and entire regions, but only after power, trade routes, and capital discovered its potential. From Ethiopia, coffee traveled across the Red Sea into the Arabian Peninsula. Yemen became the first center of organized coffee cultivation and trade. Unlike its Ethiopian origins, coffee here was controlled, taxed, and commercialized. Port cities such as Mocha turned coffee into an export commodity. This marked a critical transition. Coffee shifted from cultural good to economic asset, integrated into long-distance trade networks. Coffee houses spread rapidly across the Islamic world and later into Europe. They became centers of discussion, commerce, and political exchange. Coffee altered productivity patterns, extending working hours and sharpening focus. This was not merely a beverage, it was a stimulant that quietly supported the rise of bureaucratic states and commercial economies. European powers quickly recognized coffee's economic potential. Demand surged. Control over supply became strategic. What followed was not free trade, but deliberate replication and colonization. Coffee plants were smuggled, transplanted, and cultivated wherever imperial power could enforce production. Coffee production scaled through plantation systems reliant on coerced labor. In the Americas, coffee became inseparable from slavery and later exploitative labor contracts. The commodity enriched empires while externalizing human costs. Coffee profits flowed upward. Labor remained disposable. By the 19th century, Brazil emerged as the dominant coffee producer. Scale replaced diversity. Prices fell. Volatility increased. Coffee became a classic commodity market. High dependency, low margins, and exposure to global demand cycles. As coffee integrated into global markets, producers lost pricing power. Futures markets stabilized consumption, but transferred risk downward. Farmers absorbed shocks. Consumers enjoyed stability. This imbalance persists today. In the 20th century, branding captured value. Coffee's economic center shifted from production to consumption. Identity, not agriculture, became the profit driver. Efforts to rebalance the system emerged through cooperatives and fair trade. Yet structural inequality remained embedded in global pricing mechanisms. Coffee's journey reveals a permanent economic pattern. Commodities enrich networks, not origins. From Ethiopia to the global economy, coffee tells a story not of taste, but of power.